All right, let's talk about a classic problem, something every single investor runs into. You find this incredible company, right? It checks all the boxes. But there's a catch. Everyone else knows it's incredible too. And that's exactly the story we're diving into today with a company called SRF Limited, a real giant in the specialty chemicals world. So, you've probably never heard of SRF Limited, right? But I guarantee you've used their products, maybe even today. See, almost half their money comes from specialty chemicals. The stuff that goes into medicine and farming. Then you've got packaging films. Yeah, the stuff keeping your snacks fresh. And even technical textiles, which are inside the tires on your car. They are, quite literally, everywhere, hiding in plain sight. And here's why this matters right now. SRF is sitting right in the middle of this huge global shakeup. You've probably heard of the China Plus One strategy, where companies are scrambling to find manufacturing hubs outside of China. Well, this has lit a fire under the Indian specialty chemicals industry, and SRF, well, they're in the perfect spot to catch this massive tailwind. And when I say massive, I mean it. The size of this opportunity is just staggering. We're talking about a $50 billion global market that's essentially up for grabs as supply chains get redrawn. This isn't some passing fad, It's a fundamental shift in how the world does business, and SRF is standing right at the front of the line. Okay, so let's get into the weeds. What exactly makes this company such a powerhouse? Let's build the case and look at why they're considered a best-in-class business. First off, just look at their grip on the market. In India, they own a whopping 40% of the market for tire cord fabrics. That's huge. Then you look at ozone-friendly refrigerants, and guess what? They are the only company in all of India making them, the one and only. And don't think for a second this is just an India story. On the world stage, they're number 2 globally for nylon 6 tire cord. They're not just a big fish in a small pond. They're competing and winning against the best in the world. So you have to ask, how do they hold on to this incredible position? Well, they've built some seriously deep competitive moats around their business. We're talking about their deep technical expertise, their massive global scale, and ironclad long-term customer contracts. It's not just that they're good. They've made it incredibly difficult for anyone else to even try to compete. And this isn't some new kid-on-the-block success story. This consistent performance points directly to the quality of their management. You're looking at a team with a 50-plus-year track record of creating value. That's more than half a century of knowing how to run a world-class business and, importantly, deliver for their investors. And of course, all this quality shows up in the financials. Just look at the last 5 years. Their revenue has been growing at a steady clip, almost 13% a year. But get this, their profits have been growing even faster, at over 18% per year. That's not just growth. That is powerful, accelerating performance. And they're not hitting the brakes either. In fact, they're flooring it. The company is pouring a massive 15,000 crore rupees into expansion. To put that in perspective, that's about 1.8 billion US dollars. They're using that cash to push into really profitable new areas, like fluoropolymers. So yeah, the growth story is far from over. Okay, so dominant market position, deep moats, great management, fantastic growth. It sounds almost too good to be true, doesn't it? And that's usually the moment you need to stop and ask the most important question of all. What's the catch? Because there's always a catch. And that really brings us to the heart of the matter. We've proven it's a fantastic company, no doubt about it. But is it a fantastic investment? Right here, right now, at this price? That's a whole different question. And boom, here it is, the catch. Look at the PE ratio. SRF is trading at almost 47 times its earnings. Now, all that means is that for every dollar the company makes, investors are willing to pay $47 for a piece of it. The average for other companies in the same sector? Just 28. The market is definitely making you pay a hefty premium for all that quality. And it's not just the PE ratio. You look at any valuation metric, price to book, EV to EBITDA, you name it, and it's the same story. You are paying top dollar. Think of it like this. You found a flawless top-of-the-line luxury car. It's perfect in every way. But the sticker price is almost double what every other amazing car on the lot costs. Do you still buy it? So how do the pros handle this? How does an analyst take this amazing business and this crazy high price and come up with a decision? Let's peek behind the curtain and see how they balance the scales. This breakdown from the analysts really just lays the whole dilemma bare. Look at this. It's a report card full of A's. financial health, growth prospects, competitive position, management, all scoring high in the eights. It's beautiful. And then your eyes hit that one number at the bottom, valuation, a painful 4.2. That one bad grade just poisons the whole well. And that one bad score is what leads to the final verdict, a hold recommendation. Now, what does that mean? It's basically the analyst saying, look, this is a fantastic business. If you already own it, don't sell it. But for the love of money, don't buy more at this price. It's just too expensive. In fact, they think the price could actually fall about 12% from where it is now. And this brings us to the single most important lesson from this whole story. It's something that's so simple, but so many people get it wrong. A great company is not always a great stock. Those are two totally different things. And mixing them up, well, that can be a very, very expensive mistake to make. So that leaves all of us with a big, multi-billion-dollar question that every investor has to wrestle with. Of course, we want to own the best companies out there, but the real art of investing, the real challenge is figuring out just how much are you willing to pay for perfection.